Dr. Ishrat, give us a sense of what the global economic crisis looks like from an emerging market perspective.
I think this is a very interesting question. For the last 6 or 7 years, there has been a very fierce debate whether the emerging markets have decoupled from the global economy or not. And the present crisis has provided some partial evidence to the fact that even if the financial sectors and the financial markets of the emerging countries have somehow insulated themselves from the adverse shocks of the global economy, the real sector linkages are still very strong, and they affect the growth, the output, unemployment, and the living standards of the people. So even China, with its $2 trillion of reserves, which accumulated over last 15 years or so, is not able to face the decline in the growth rate of the OECD countries. So the growth in China is going to be 6.5%, 7%, which is much less than the wanted growth rate. I think what we have learned both from the Asian crisis as well as the current global crisis is that cautious liberalization is much better than unfettered liberalization.
What are the elements of a cautious
liberalization is, for example, in our case in the Indian subcontinent, we did not allow full capital account convertibility. We have current account, and the trade and other current account flows can come in and go out, but we do not allow residents of India or Pakistan to convert their domestic savings and domestic deposits freely into foreign currency accounts. So there is no element of speculation on the currency. There is no exodus of money going in and out. We also do not allow the businesses to go and borrow indiscriminately. There are restrictions on external commercial borrowing, and there are restrictions on equity investments also. There are limits, and India, after having accumulated large reserves, raised the ceilings, but even today you have to abide by those ceilings. And in Pakistan also, equity investment is encouraged but allowed and qualified by the central bank.
But when you have restrictions like these in place in an emerging market, doesn't the banking industry go around it and try to look for ways in which it can access cheaper forms of funding, for example?
Well, it doesn't, because what happens is that the regulator is very vigilant and is acting as a sharp watchdog.
Well, I mean, if you take the Japanese carry trade, India, for example, was one of the beneficiaries. So the Indian banks that had greater access to the global markets were able to benefit from that, despite restrictions in external borrowing.
But the RBI was keeping them under watch, and there were moral suasion where the RBI felt that some banks were going too much in one direction. Then they were called to the Met, and they were told about it. So I think the difference is that how much integration of your own financial institutions is with the rest of the world. If it is on the margin, it really doesn't matter. But if it's fully integrated, then you have the kind of problems you're talking about.
Now, when you take a country like Pakistan, Pakistan was a great beneficiary of the remittance business.
Yes.
So you did have an inflow. It may not have been hot money in terms of FDI, but it was definitely much needed funds.
No, but we got a lot of FDI. Last year, 2007, 2008, a year before, we had almost $6 billion of FDI, which is almost 3-4% of our GDP. So there are no restrictions on FDI. But there are restrictions on the portfolio, hot money, because hot money can come into specified amounts in specified accounts, and we keep a watch on that, whether this money is being used for the purpose for which it is brought in. So the point I wanted to make is that if you have a strong, vigilant regulator, then you can allow the financial flows to come in and go out without causing so much damage. But if you're sleeping on the wheel and you do not know what really is happening, then the problem is...
Just for the sake of completeness on the topic of decoupling, how would you classify Pakistan and the Indian subcontinent differently from the East Asia that had strong manufacturing links with the West?
I think in case of India, they have integrated very closely with the rest of the multinational corporations, the Fortune 500 companies, through the IT platform. Most of the R&D centers today and the call centers and other outsourcing business processes taking place. So if anything happens to the Fortune 500 companies, that will also affect the demand for services in India. So that is a very peculiar kind of relationship. But the trade GDP ratios are not still very large. And to that extent, I mean, Malaysia and Singapore have 100% or more than 100% of GDP. That's not the case in India and Pakistan. So I would say that services sector would affect, but not the manufacturing sector decline would be that much.
As one of the leading regulators who put in place fundamental transformation of the regulatory regime in your country, what do you see taking place in the global regulatory dialogues today that you may be concerned about that might affect the way in which regulators in emerging markets can function?
I think the problem arises in the US. There are 5 regulators: FDIC, Fed, Reserve, SEC, OCC, and state banking superintendents. So there is a lot of opportunity for regulatory arbitrage between. Second, the regulatory institution has to choose as to which regulator they want to be regulated by. And these, to me, are very explosive ammunition for what is happening today. So I think the regulatory reform has to start from the US, where there should be one primary lead regulator for the same institutions, for the same kind of activities, for the same markets. It cannot happen that if you are doing hedge fund under one particular institution, hedge fund is being regulated by somebody else, and the investment banking is being regulated by some other. There should be one regulator for the entire spectrum of activities.